All right, all right, all right, all right, all right. So everyone in the class, very, very welcome to this session. Very, very welcome to full English power batch for Jan 2026 attempts and onward attempts. Batao bhai, everyone, how are you all? How is everything going on? You will have to please confirm if I am clearly audible, visible, what is the status? Once you all confirm it, then we talk further. People, say something in the chat box so that I can get to know if you can hear me, see me, what's happening. Very good morning, everyone. Is everything all set? So Aksa is here. Very good morning, Aksa. Others in the class, live people, recorded people, welcome to the session. Who all do we have? Hi Avinash, very good morning. Great. So a lot of people, a lot of students think that, sir, what is the point of starting the power batch now, which is generally after the results? So obviously it will make absolute sense since now we have attempt 3 times in a year, right? Starting early is never a bad idea. Those who are very clear with their plans, that sir, I have to anyway appear for group 1 in the coming attempt irrespective of what was my result for group 2, or those who are anyways appearing for group 1 for the very first time in Jan 26, for all such students, this batch can turn out to be the result changer. So let me very clearly ask you a question. Everyone, have you ever set a target for a subject of AFM? All the live people, all the recorded people, please answer this question. Have you people ever set any target for AFM? Before this discussion that we are making, come on, please respond. Let me also check if any student is facing any struggle to join in. Wait. No struggle here. Telegram all set. Cool. Yes. So some people think it is exemption, some people think it is 70 plus. Is it really possible to have a target of 80 plus in the exam of AFM in all possible situations? When the paper is easy, when the paper is from the study material, we can obviously do it. But is it really possible to score such great marks even when the paper is out of the box? Even when the paper has new and tricky questions? What do you think? Is it possible? And that too with this batch, just a 75-hour power batch, is it possible? What do you all say? I want to clearly raise the bar. I want to clearly set the expectation of what this batch can do for you. And in turn, I want to also set my expectations from you that to be able to score 80 plus, how much efforts do we need to make in the class and at home? Yes. So let me very clearly tell you, with this batch, the kind of efforts that we make in the class, the kind of teaching that you will have, that you will experience in this batch can literally make your result a result changer for the entire group or for all 6 paper, both the groups, right? You can through this subject make the aggregate if needed. At the same time, sir, let me also explain to you the approach that we will have in this batch. so that you get a clarity of what exactly we are going to do in this batch. We'll take out some extra 5 to 10 minutes to do all these things and then we start the study. Alright. So let me very quickly introduce myself. You all know my name now obviously, but not maybe a few things beyond it. So my name is Adesh, you all know. You also know my qualification. I'm a CA and CFA. The background is really simple. So in 2016, I cleared my CA. After clearing CA, I worked with equity research. I worked for equity research with 2 companies. For a year, I worked with Morgan Stanley. Another year, I worked for ICICI Securities. So after working for 2 years in these companies, I decided to come back to my hometown. And before I say that, people, do you know what equity research is? Come on. All the live people, all the recorded people, do you know what equity research is? Please tell me. Have you ever heard what this is? Come on. No, not heard. Do you know the stocks listed on the stock exchange? Share of TCS, Reliance, Zomato, Paytm, whatever. On those stocks which are listed on the stock exchange, you have to do the research. The research on the business, research of their analysis of their financial statement, research and analysis of the industry in which that company operates, that of an economy in which that company operates, research on the management who's running the company. Sir, research and analysis on entire company, business, economic, financials, everything, competitors, everything. When you do that research, when you analyze it, you try to arrive at the value of the company. In the subject of AFM, do we have this practical chapter of valuation, equity valuation? Yes. So the same concept of valuation that we learn here at an advanced level are applicable while valuing the real world companies, for which you also need some another level of skills called as financial modeling. Yes. So that is equity research, where you value the company and then ultimately come to an advice whether this company is worth purchasing or not. Should we invest in this company or not? And if we invest, what is going to be the target price in our opinion? For example, price of the share of the company is right now 3000. In your understanding, as per your financial model, the target price that you set is 3500. So then you say that, okay, this share is worth buying. Today I can buy it at 3000, whereas I see the share price can reach, it has a potential to reach to 3500, giving you a gain. Yes, that is what broadly equity research is. So after working for 2 years in equity research, I decided to come back to my hometown, which is Indore. Have you people also heard of Indore? Come on. So before I speak further, can you please tell me which cities are you all from? Everyone? Which cities are you all from? People in the class. Or which state? Akshay from Kerala. Avinash, you're from Chennai. Who else? What else? Everyone. Chennai. Sivasuryan. Then Atulya, Kerala. All right. Have you people have heard of Indore as a city? What do you all say? Sarvendra, you're from Gorakhpur. Akshay, it's not in UP, it's in MP, Madhya Pradesh. Only the name, Atulya, for Indore. Alright, so I decided to come back to my hometown Indore, right? And then I started to teach. So what all do I teach? I teach CFA, I take training sessions on financial modeling, and obviously I teach CA Final AFM, for which we are sitting here. Yes? So in this batch, we will be extremely exam oriented. We won't talk about the things that I have practically learned about valuation, research, finance, etc., nothing. We will be precisely exam oriented. But that's really true that to be able to be exam oriented, the logics are never compromised. You have to please realize exam orientation doesn't mean only the question solving. To an extent, we will have to also talk about the underlying logic, underlying background, so that you don't have to mug up the things. Given any concept, if you understand the logic, obviously the element of remembrance, the element of mugging up has gone. And through the discussion of logic, listen to my lines very carefully. Through this discussion of logics, I want to evolve you. I want to evolve your thought process. I want to generate in you an ability to think. Think for what? Think because every single student in the class, people please listen, we want all of us to be capable of solving even newer questions. Can we go to the exam hall by expecting that we will receive the same set of questions? Although institute has been doing it, but can we expect the same standard or same benchmark for ourselves? No. 1 in 5 attempt is such that where the institute asks new question, tricky ones, different ones. And only the students who has that clarity of concept, who has that ability to think, who has that brilliance, intellect to understand the question and apply the logics on that question will be able to tackle such paper, and all those thought process building abilities we are going to work on in our class. Do you realize I'm raising your expectation, which can be trouble for me only, but I am confident of doing it, which is why I'm saying it. People, are you all aligned to what your expectation from this batch should be? Yes? So after this very brief introduction of myself, I have slightly shared with you what your expectation should be. I'll also show you the notes we're gonna refer. So with this batch, you'll receive 2 soft copies. One for the question bank, another from the concept notes. Both these soft copies are same set of things that a regular batch student receives in hard copy. Same. There's no compromise. There's no shortlisting of question with you. Exactly same set of things you will receive. Do you people see some background noise disturbing you? Super ultra fast, please respond. Are you people facing some background noise? Is it disturbing you? Come on. Do speak up in the chat box. Yes, everyone. Sorry for that background noise disturbance. So let me also share my screen, and on the screen show you people the kind of notes you will receive. People, are you all there? So sir, we have first thing our very unique concepts notes. Super ultra fast, let us understand. These are my own designed concepts notes, where all the concepts that you see, all the concepts are learned in the form of tables, diagrams, charts, structures, rather than pure text. With this, the learning become really easy. First, The book looks more colorful and interesting, which makes the revision very easy, which makes the retention very strong. I'll give you a simple example. If I teach to you a particular concept, you may not be able to remember, but if I teach to you the concept through this timeline, you will be never able to forget this image. Your brain has ability to capture the image so effectively that even if I ask you to forget it, you won't be able to forget it now. That, sir, this is how for example, this is how the timeline is, this is where we stand, this is how you discount, what is this showing, that showing, everything you'll be able to forever remember, right? Which is why this timeline driven, structure driven, diagram table driven charts is what the outnotes is. These are in the class. Sir, are we going to understand the concept? Yes, the answer is really well. Every concept we learn right from the scratch, right? But sir, are we going to also write them? Come on, everyone in the class, it cannot be a joke to write down the concept in this a small batch of 75 hours, understand it and also solve the practical question. It's not possible. Sir, the concepts are already written down. The notes that you see right now are the notes from a regular batch. The same notes you're gonna refer to learn the things. You learn it really well, then we go to the practical questions, right? I'll also open for you the practical question notes. Hold on for a second. This is the outscanner, the question bank that a regular batch student receives, right? Let me tell you everything about this question bank to you. We'll spend some time here so that you get confidence on what you're doing. You should know very clearly what you're doing. Sir, this notes they are very comprehensive. They include questions of RTPs, MTPs, exam paper, study material, any other place like Institute Board of Studies website, anywhere. Not just the recent question, right from, I think, exam of 2002 till the attempt of September 25 exam paper. All those questions in this question bank are included, people in the class. Every question relevant for your exams has been included in this batch from there, like since then till now. Yes, we have with every question tried to tag it with its attempt, also tried to tag it with a QR code. Sir, what is this unique thing again? Everyone, this QR code, if you scan through a particular application, you will be able to see the video solution for this particular question whenever you want and as many times as you want. You take this batch today. Suppose after a month you are not able to recollect what was the treatment of this particular line. You are not able to understand it despite looking at the solution. Although the solutions are very clear and specific, despite suppose you want to figure it out, what do? You scan it, you look at the video for that 5, 10, 15, whatever minute video, go to that particular point where that thing is explained and get your query solved. That simple can be the thing. Also, we have tried to incorporate in these outnotes something called as self-note. Suppose in a particular question there is an ambiguity which institute has made, or suppose there is a confusion or something which is a point of remembrance. All those important things have been included in questions through this heading called as self-note. For example, in this question, institute has missed the rate of discounting. So I've put a self-note with respect to it, and how the answer of 7% has been used is explained. That is the case with any question where a self-note is needed. For example, out here, as we see that institute's information is missing, or even if it is specific, you will find it difficult to process. What we have done, we have attached a self-note to it for your ease. That is the clarity, that is the precision or perfection with which we are working. We will work in the class with our outscanner, the question bank. Now, very specifically, let me tell you, Outnotes hard copy cannot be purchased. But Outscanner hard copy, people in the class, can be purchased. In fact, let me rectify myself. I'll talk to the team. I'll figure out if a Outnotes hard copy can be printed and made available for the students. That I will try. I'm not committing, I'll try. Right? But Outscanner hard copy can obviously be purchased, and only students with the hard copy will be able to access this facility of QR code. Everything else is there for you. But this QR code facility will work only if you have a hard copy. Through soft copy, you cannot access it. Because when you do purchase a hard copy, your details get captured from the backend. You have been given access to the QR code, and that everything takes place. Yes? So the approach is clear. Sir, what about question solving in the class? So in the class, we will try to solve unique, different, ambiguous, comprehensive nature of questions. Right? Very rare nature of question we won't solve in the class, the probability of which asking in the exam is negligible, whereas rest of the question will be done by you, which are similar easy nature questions will be done by you in the form of homework. Sir, will we solve the questions by writing them down? Let me very clearly specify. When it comes to understanding the question, there is no compromise. I'll explain it as I explain it to any other batch student. But when it comes to solving it, we will solve it on the calculator. I'm not saying we will just audit the numbers. For most of the questions, we will solve it on the calculator. Sir, we won't be able to write them down. So this extra effort of writing down the questions, you will have to put at home, but it will worth the effort because that will be reflected in your revision. That's how the approach is. Yes? So everyone get excited, get really energetic because you are taking your first step today to secure 80 plus marks in AFM. Let us in your attempt make AFM be your result changer. Yes, your aggregate maker, your everything. So are we all very clear with what is going to be the approach? All the live people, all the recorded people, do you people want to ask anything? If yes, you all may ask. If no, we start with the studies. Everyone, please speak up. What do you all want me to do? Are you all there, sorted with what the plan is? Come on, come on, come on. Show me your energies, your excitement by hitting the like button. People, come on. Right from books till the approach, till everything has been shared. Yes? Are you really hitting the like button? So well, no worries. Only in this lecture where you feel that, sir, this is something I've learned clearly, I have liked this concept, you show me that by liking the video and that will be sufficient. Yes? So let us everyone get started. Let me take you to the notes. Right? I'll request everyone to be connected to the Telegram channel, especially when the batch is going on. Also, I'll try to make a WhatsApp group or something only for the live people specifically, so that live batch related communication regarding timing and everything we can do. So live people, you will get a link either through WhatsApp or through email, the link of the group that we create. Other than that, you will have to be all updated on the Telegram group, obviously, Telegram channel, obviously, right? Also, those who purchase the power batch will receive an email in I think 2 working days or maybe less than it. I'll ask the team to do it on priority basis, right? Where you will receive the serial keys and everything, and of Google Drive folder where you will get the access of lectures, right? Also, you'll get the link of the apps to be installed. All those things will happen, right? Next, everyone, if you purchase the hard copy of the book, you will separately receive an email from the name of fastcredential@gmail.com, something like this, which will have the details of which app you have to download to scan the QR code, and you will also get your ID password for logging in through that app. through which you can scan the QR code and watch the video solutions. Alright, so now very ultra fast everyone in the class, let us proceed. I will very immediately take you to the concept notes. Right, if I show you, I'll talk about all the practical chapters. This is how the institute's study material chapters are. Yes, people? For example, financial policy, risk management, advanced capital budgeting, security valuation, and so on. Right? All these topics have been reshuffled for your ease, for your better learning. For example, if I talk about the chapter of security valuation, everyone, we have 3 type of securities, 4 type of securities particularly covered in that chapter. First is preference share, then is bond, then is money market, then is equity valuation. The thought process for these 3 security is same. Whereas the thought process needed for equity valuation, everyone in the class, aligns with business valuation thought process, which is why these 2 chapters have been merged as equity and business valuation, and these 3 securities have been merged with the name of fixed income security, and these 2 different chapters have very different thought process. Yes. Similarly, for example, derivatives and interest rate risk management, you need similar thought process, which is why they have been merged to derivative and interest rate risk management. And that is how people, if you look at the chapter's name in the notes, that's how they will look like. Yes. And these chapters index is given here. Sir, the very first thing we'll do in the class today is learn the basics of AFM. After learning the basics, this is the sequence in which we will do the chapters. Right from equity business valuation to M&A to fixed income portfolio and so on. There is a possibility we might end up doing capital budgeting just before Forex. There is a possibility. We'll figure it out at that point. So today, sir, we start with basics of AFM. Sir, I'll talk about everything that you have learned in your regular batches. I'll talk about everything that you have at some point learned in your life, maybe CA intermediate, correct? So boss, the very first thing you all need to learn is learning how does the income statement look like and what can be the questions based on income statement be. The very first number in your income statement is revenue, from which if you deduct the manufacturing cost, which is your COGS, you are left with gross profit, right? From which if you further deduct general admin expense, marketing distribution expense, what you are left, everyone in the class, is EBITDA. Earnings before interest, tax, depreciation and amortization. People, we have not deducted depreciation in any of these category of expenses. Depreciation is yet to be deducted, interest and tax is yet to be deducted. Sir, then I deduct the depreciation. And then I get the profit, which is called as EBIT, earnings before interest and tax. EBIT is called as operating profit. Why? Because revenue is from operations. Listen to me very carefully. Revenue is from operations. All these expenses of COGS, marketing, distribution, general admin and depreciation, all these expenses related to operations, calling them to be the operating cost. Revenue is operating, cost are operating, cost deducted so far are operating. So obviously the profit so arrived will also be the operating profit. EBIT is called as operating profit, and similarly EBITDA is called as cash operating profit. Sir, what is this? Sir, if you realize while calculating EBITDA, has the depreciation and amortization been deducted? No, sir. Which is why can I say the non-cash expenses have not been deducted so far? Correct. Which is why I call it to be the cash operating profit, because after it as the depreciation has been deducted, is this profit a cash profit? No, sir. It has now become an accounting profit. Yes. From EBIT, what is the next thing you deduct? Everyone, next you deduct is interest, and what you get is earnings before tax, profit before tax. Then you deduct is tax, what you get is profit after tax, earnings after tax, net profit. From the net profit, if you deduct preference dividend, you have to please realize debt holder. We have 3 capital provider: debt, preference, common equity. Debt has been paid in the form of interest. Preference will be paid after the PAT. So from the PAT, if you pay to the preference shareholder the amount of their dividend, then what you are left is the earnings which will be available only for the equity shareholder. Because interest has been paid to debt, preference dividend has been paid to the preference shareholder, all that is left now will belong to common equity. From that earnings which is available to common equity, what do we call it? Earnings available to equity shareholder, EAES. From these earnings, if you distribute the amount of equity dividend to them, then rest of the profit which is left with the company will also belong to equity, just that it is not distributed in cash. These are called as retained earnings. The format of income statement, everyone in the class, is really easy. You need to now learn what kind of questions institute may ask, which make use of this. One possibility is institute may ask you to make an income statement. Sir, prepare an income statement. In a very rare category of questions. Second possibility is that in various calculation across the syllabus, you will be needed to calculate EBIT or EBITDA or PAT or PBT or EAES, anything. Only when you know the format of income statement, you will be able to calculate correctly the level of profit which is needed. Because if you don't know where is the item of COGS, admin, general, depreciation, tax, interest is deducted, if you don't know the treatment of these items, obviously the question solving will be difficult. It is all easy although. And the last can be, sir, institute based on income statement may give you certain ratios using which the question may be handled. For example, institute might give us revenue and say gross profit margin is this. Institute might give us revenue and say operating cost margin is this. Institute might give us operating profit margin or net profit margin or anything. So using those formulas, we will have to, people in the class, solve the questions. Sir, what is the formula of gross profit margin? Sir, gross profit as a percentage of revenue is gross profit margin. Sir, EBITDA as a percentage of revenue is EBITDA margin. EBIT as a percentage of revenue is EBIT margin. Net profit, PAT as a percentage of revenue is net profit margin. All my operating cost as a percentage of revenue is operating cost margin. या फिर operating cost ratio I must say. This is how the income statement look like. The same income statement can also be prepared using another approach, using costing approach, SCMPE approach, where you distribute the cost in terms of fixed and variable, where you also talk about the volume of units sold. So what we say, sir, suppose there is a selling price per unit of a particular product. From that selling price, if you deduct the variable cost per unit, you will be left with the contribution per unit. Multiplied by the number of unit will give you the total contribution, people in the class. From this total contribution, we will have to deduct the fixed cost and the depreciation. Once you deduct the fixed cost and depreciation, what you will be left with is called as, everyone in the class, profit before tax, right? Because all the expenses have been deducted. Sir, where is the interest deducted? Sir, for these category of questions, right, which is primarily there in the capital budgeting, we don't talk about capital structure, we don't talk about debt versus equity, which is why interest here has been ignored. And you can also ignore it, no problem. You can recollect any question of advanced capital budgeting from CA Final or CA Inter. Did you ever see an interest rate to be considered in the calculation? No. Yes. Sir, after deducting depreciation, what you get is called as PBT. When you do 1 minus T multiplication to it, you get PAT, which is your profit after tax. And that's how you can directly calculate PAT in the form of equation, where the approach is different, because out here the costs were given on the basis of whether it is COGS or general marketing admin. Here the cost is given in terms of whether it is variable or fixed. At this point, I need a validation of all the live students sitting here. Are you people aligned to the discussion we have made on this particular page? How much out of 10 are you people settled? Please give me response to this thing. Everyone, speak up. Come on, come on, come on. How much out of 10 are you people please settled? Speak up. Avinash, 10. Other live people in the class, recorded people, are you all able to understand what is going on? Sarvendra, 10. Aksa, 10. Atulya, come on. Siva Suryan, what do you say? Set. Fine, sir. So this was the format of income statement. Now we need to learn certain basic ratios which will be of use. Which will be of use to us everywhere. Sir, first one is EPS, earnings per share. This is calculated using the financial statements. Because earnings are there in the income statement, right? Income statement is a part of financial statement. So, sir, we have the number of earnings. In terms of earning, we have EBIT, we have PBT, we have profit after tax, we have various forms of earnings. But out here, we want to calculate the earnings which belong to who? Can anyone in the class tell me that EPS is calculated from the perspective of debenture holder, preference shareholder or the equity shareholder? Come on, please. From whose perspective do we calculate the earnings per share? Please speak up. From the perspective of equity shares, sir, obviously, and which is why we will in the numerator take the profit which belong to equity and we will in the denominator take the number of share which belong to equity. The common sense is really simple. Sir, this is the profit that belong to all the equity shareholder. If I divide that profit by the number of equity shareholder, will I be able to figure out how much earnings, how much profit one particular share has? One particular equity share has, obviously calling it to be the earnings per share. The income statement is there for you on the screen. Can you all please tell me? Of all the profits that you see on the screen, all the live and recorded people, please respond to it. Which particular profit do you think belongs particularly to equity and only equity in fact? Please. And let me in the meantime have water. Please, just a minute. All right. So could you identify the profit which particularly belongs to equity? Think about it. Sir, is the PAT available to equity? No, sir. PAT belongs to both equity as well as debt, as well as preferred equity. Sorry, not debt, preference shares. So after deducting the dividend of preference share, then is the profit left which belongs only to equity, calling it to be EAES, Avinash, Atulya, Aksa, and every live and recorded people who thought of EAES is correct, obviously. So EAES you divide by number of share will give you EPS. Sir, what if there is no preference share in the company? Then there would be no preference dividend, which means PAT minus the preference dividend give you EAS. If there is no PAT, no preference dividend, can I say PAT and EAS will be same, and that is why they may be interchangeably used in the formula, assuming that and only when the preference shares are not there with the company. Yes. Sir, next is book value per share. Sir, if I want to figure out, please listen to me. There is absolutely no point of mugging up any of these formula. If you understand the names, you will automatically understand the meaning, the formulas, everyone. Book value per share. For every share, how much is the book value? How much is the value as per books? How much is the value as per financial statements of the company? But for every share, which share? Obviously, again the equity share. For every one equity share, how much value do they have as per the balance sheet, as per the financial statement? So the logic is really simple. Please imagine the balance sheet. In the balance sheet, find out the value of equity. The total value which belongs to the equity, divide that value with the number of shares by the number of share, and you will automatically get how much on a per share basis the value of equity share is. Aligned? Again, can I say this one is also based on the balance sheet, the financial statement, has nothing to do with the market price. Nothing to do. Please everyone help me think in the class. Sir, what are the values that belong to the equity? Sir, can I say equity share capital belongs to equity? The retained earning, the reserves and surplus in the balance sheet, they also belong to equity. Sir, in the asset side of the balance sheet, if there is an unamortized expense, anything in the form of unwritten off, profit and loss or preliminary expense or any other kind of fictitious asset, everyone, that is deducted from the amount of capital which belongs to equity. Because this is a loss which is yet to be borne by equity, we eliminate this loss and then say this is the net balance of equity, claim of equity there as per balance sheet, as per financial statements. The same thing can also be thought otherwise. Which means if I want to find out the value of equity, I can either follow equity approach or I can otherwise take all the assets and deduct the liabilities from those assets and automatically I'll be left with equity. So I will say let me take all the assets. So land, building, furniture, stock, inventory, debtor, cash, all the assets. Excluding those fictitious assets because they are actually not my assets. From these assets, if I deduct the liability like creditor loan, if I deduct the claim of preference shareholder, what will be left is automatically the claim, the total value of equity shareholder, calling them to be equity shareholder fund, ESHF. Yes. In these outnotes, we have tried to also write down the acronym or the abbreviation which can be officially used in the exam hall. Yes, I've tried to be really very systematic and organized with these notes. Sir, when I write down ESHF, you can at any point go to the basics and figure out what it was. It is Equity Shareholders Fund. However, although you will now remember it, this is the total claim of equity shareholder as per books. This total claim when divided by their number of share, I get the value of equity as per books for every one share, calling it to be the book value per share. Yes, people, at every point now I will validate from you if the level of understanding is 10 on 10 or not. Slightest level of doubt, you have all your rights to ask me. No question is ever silly or less important. For you, it if affects your learning is very important, is the simple point. Please everyone validate and respond for the concept of EPS and book value per share. Are you all 10 out of 10 settled? Come on. Come on, come on. It being lecture 1, I am happy to go slow. I am happy to talk about the details which can later be the problem. right? I am ready to invest this amount and we will invest. Come on. People, are we all set? Anyone, any doubt that you want to ask? Next is return on equity. Return on equity. People, let us think. Sir, this was financial statement, this was financial statement, and this is also a return which is financial statement based. Those students who are lagging behind, please, I would request you all to drag that red line to the latest point on your YouTube live. आपका जो भी latest, sorry, my bad, I started to speak in Hindi unfortunately. I'm saying that on your YouTube screen, please drag your, what do we call it, that red line with the dot to the latest point so that you all can communicate live. Okay. Sir, return on equity, a kind of return we calculate. The return who's earning, the return equity is earning. Guys, wherever I talk about the formula of return, the common sense is really simple. In the denominator comes an amount that I'm ready to invest, and in the numerator will come an amount I will be able to earn on my investment. For example, if I tell you, you invested 15, if you invest 200 rupees, you invested 200 rupees somewhere, and after a year you are able to earn 30 rupees in the form of return from that investment. What is your return in percentage terms? Please tell me. You invested 200 rupees, you get 30 out of it next year. What is your return? Can I say 30 divided by 200, which is everyone in the class, 15%? So the common sense is really clear. In the denominator comes an amount that you invest, and in the numerator comes an amount that you earn out of it. Agreed? That is what you have to do even here. Think about balance sheet. Think about financial statements. What is the amount of equity invested in the business called as, sir, it is called as equity shareholder fund. Equity shareholder fund. That is the total amount of equity invested in the business, and against that investment, what do you earn which belongs to equity? Sir, the one which belongs to equity is EAES. So EAES is what is earned against an investment of equity shareholder fund, calling it to be the return on equity. Denominator says how much you invest, numerator says how much did you earn on that investment. The same logic can also be thought on a per share basis. Sir, equity earnings available to equity shareholder, if I divide by number of share, I get EPS. Similarly, equity shareholder fund, if I divide by number of share, I get book value per share. So logic remains the same. On a per share basis, as per balance sheet, how much is invested, book value per share. And on a per share basis, as per income statement, how much did you earn, EPS. So EPS divided by book value of per share is also the formula of return on equity. Are you all please settled? Sir, similar to how we have to calculate return on equity, we might also be needed to calculate return on capital employed. When I talk about capital employed, it is not just the equity, it is but equity plus debt plus preference, your overall capital employed in the company. And please always remember, the numerator and the denominator are aligned. In the denominator, if I take the capital of only equity, then in the numerator I will take the profit which belongs to only equity. Similarly, in the denominator, if you take the capital of all the capital providers, which is equity plus debt plus preference, then in the numerator you will have to take the profit which belongs to everyone. Are you able to connect? Sir, look at the income statement and tell me which one is the profit that belongs to everyone. Sir, EBIT is that profit which belongs to equity and preference in debt, because from this profit none of their payments have been deducted. Are you all able to connect that, sir? EBIT is that profit which belongs to everyone. So logic remain the same. Denominator has amount we invest and numerator has the income that got generated on such investment. EBIT divided by capital employed. People, please respond. Are you understanding the simple formula of return on equity? Speak up, speak up, speak up. Come on. Recorded people, live people. Although the discussion that we are making in the class now is really basic, I would still want to know, is this discussion helping you out to rebuild the basics or maybe recollect the things or make the concepts more firm than previous ones? Is this discussion on the basics helping you out? Come on, live people, recorded people, please speak up. Just a minute. Is it adding value to your knowledge? What do we all say? Is it, people, adding value to your knowledge? Yes? So great. Then we talk about the next discussion, which is market price per share. Market price per share is a simple thing, it is there in the market. Normally it is there in the market, you don't have to calculate it is given in the question. Similar to how market price is a per share number, market value is a totality number. Market capitalization, also calling it to be the market value, is a totality number. Sir, value of share in the market for one share is market price, but value of all the shares in the market is called as market cap. There can be two contexts of market cap. It can be called as full market cap or free float market cap. The logic is very simple and easy. Suppose there is a company having 1,000 shares of rupees 15 each. If I look at the shareholding, everyone, 700 shares are held by promoter, which means ownership of promoter is 70%. And general public like you and me holds 300 share, which is 30% of the company. So if someone asks what is the overall market value of the company, full or total market cap of the company, it's really easy. Sir, 1,000 shares of 15 each is 15,000 rupees, being the market cap. Sir, what about the free float market cap? What about the free float market cap? Sir, of this entire market cap, which one is getting traded in the market, which one is freely floating in the market? Sir, are the share of promoters being traded in the market? Can Ambani from Reliance can also sell his shares on the stock exchange as easily as you and me can do? No. Their shares are not listed or traded on the stock exchange as freely as our shares. So only the shares which are not held by promoters, the one which are held by general public, are free float shares, and market cap of these shares is called as free float market cap, which means 300 shares at a price of 15 give me 4500 as the free float market cap. Or I can also say that out of this entire market cap of 15,000, 30% is general public, 30% is free float. So 15,000 into 30% is again the same answer of rupee 4500. Agreed? Simple. So sir, let's clear this confusion. We have learnt about two kind of values. One which is as per the financial statements, another which is there in the market. Listen to me now, listen to me. 1 second. Sir, the value as per books, the value as per financial statements on a totality basis, the value of equity as per financial statement on a totality basis is called as equity shareholder fund. And on a per share basis, it is called as book value per share. However, the value of equity in the market on a totality basis is called as market cap, and on a per share basis, it is called as MPS. Everyone. Are you all again aligned? Are you all set? Can we proceed? Please give me a response. And this is your commitment. Wherever in this lecture you feel that yes sir, we have learnt it better, this was an addition to my knowledge, you will have to show that by liking the video. That's what you committed, right? Not now. Wherever in this lecture you feel that sir, this is we have learnt more clearly. Come on. People, shall we proceed? Are you all there? Shall we proceed? Come on. Now I take you all, people in the class, come on. Let's proceed to the next one. Now I take you all to the next ratio, calling it to be the price earnings ratio. The most simple ratio called as PE ratio. Everyone, PE ratio. The name itself is the formula, if you all realize. Price of a share divided by its earnings. Price of a share is officially called as MPS. And earnings of a share, equity share, is called as EPS. So people, MPS divided by EPS is this ratio called as price earning ratio. In the exam hall, you may be needed to calculate P ratio, or it may also be needed that P ratio is given, EPS is given, and you are expected to calculate MPS. So logic remain easy. MPS is equal to EPS multiplied by the P ratio. Yes. So that also gets done. So now we talk about dividend. People, the context of dividend in the entire AFM can be in various ways. We may also be given the amount of total dividend, to which if I divide by the number of share, I get the per share dividend, calling it to be the DPS, dividend per share. This is first way information of dividend may needed to be processed. Total dividend divided by the number of share giving me per share dividend. Then, sir, dividend may also be given in percentage terms. Dividend as a percentage of face value is called as dividend rate. Dividend as a percentage of MPS is called as dividend yield, and dividend as a percentage of earnings is called as dividend payout. All three contexts, let us learn one by one. Suppose a company says we distribute 30% dividend. That is dividend rate. It is as a percentage of face value. Yes. DPS as a percentage of face value is dividend rate. So if company says 100 rupees face value and we distribute 30% dividend, you should be able to connect that 100 multiplied by 30% is equal to rupees 30. Just a second. Just a second. Give me a second. People, please give me 2 minutes. I'll be back in 2 minutes. All right. So, people, sorry for the gap, sorry for the disturbance. We are back. All right. So, where were we? We were everyone in the class trying to understand that dividend in any given question can be in absolute amount, like the dividend per share, it can be in the form of rupees or dollars, or it can also be in percentage. For example, dividend can be given as a percentage of face value. Similarly, dividend may also be given in form of yield. For example, examiner might say that price of the company is 1000 rupee and dividend yield is 3%. So how much is the amount of dividend? Market price multiplied by yield is the amount of dividend of rupees 30, right? So one possibility is you may be needed to calculate the yield, which is dividend as a percentage of MPS. Another possibility is yield is given and you may be needed to calculate DPS, right? And one more possibility, dividend can also be in the form of earnings as a percentage of earnings. For example, company has earned rupee 10 in the form of EPS. Of rupee 10, 6 is distributed, 4 is retained. So can I say 6 rupee out of 10 is distributed? So how much is dividend payout ratio everyone? 60%. And how much is retention ratio? It is 4 out of 10, which is equal to 40%. So can I say 60% of payout ratio plus 40% of retention ratio is equal to overall 100%. In other words, if I am given EPS and if I have been given the dividend payout ratio, I can calculate DPS. The answer is yes. If I have the EPS and if I have the DPS, I can also find out the retained earnings per share. Out of 10, 6 is distributed, I can find out 4. In other words, if I say the payout ratio is 60% and I know the total is 100%, it obviously means the retention ratio is 100 minus 60 is equal to 40%. These are the possibilities in which the given formulas may be used by the examiner in any question. Yes, everyone. Are you all please understanding what is going on? Speak up, come on. Yes. Similarly, this is the impact on market price. We don't need to learn now in this batch right now from exam point of view, but yeah, this we have done. Sir, now we have certain ratios. These ratios are not to be specifically learnt right now, but in the entire syllabus, wherever in any question we come across a ratio, we write them down here. That's how all the ratios applicable in the entire syllabus are compiled on this page out here, so that one day before the exam you don't have a struggle of remembering this ratio from that question and this ratio from that question. No, everything is compiled on at this page. Your life remains sorted. Yes. So okay sir, all right, even the ratios are done. Now I will take you ahead on different types of returns. Everyone in the class, are we all really set to go on? Please speak up. Are we all really set that we can proceed? Come on. Come on. So all right, in the meantime, will you people share, all the live people who are sitting here? So how is the Navratri vibe in Kerala or Chennai or the places where you live? People, I mean, do you have offs, holidays? Do you do pujas and everything during these 9 days or especially the 9th day? How is the celebration out there? Come on, tell me, how is the Navratri vibe out there? This is just out of curiosity as well as, one second, let me set the camera. This is out of curiosity as well as to understand your availability for the next 2 days. Because tomorrow, let me tell you, we will have some kind of puja. So tomorrow morning we don't have the session. But day after tomorrow, which is Dashera, I am available. So if you people are also available, I would want if we can keep the lecture day after tomorrow. How many of y'all are in for the lecture day after tomorrow, people? Aksa, you are. Come on, Atulya and other live people in the class, please speak up. Will you be available? Avinash. So, exactly, I wanted to understand your availability for the next 2 days. Clear? We should prefer to keep the lecture. Tomorrow I have to travel to another city, which is why it is almost impossible. Day after tomorrow, is it possible? Especially, will you be able to manage from 9 to 12? What do you all say? Come on. 9 to 12, will you be able to manage? I would request if you can. Chalo, we'll figure it out. We'll figure it out later. Done. So boss, we will come across these returns, different kinds of returns in the practical questions. So we need to understand them really well. One is required rate of return, another is expected rate of return. I'm sure you people have heard these words before. How many of you have heard these obvious words called as required and expected rate of return? Almost everyone? Almost everyone. Now my point is, there is a difference between the two. In fact, the meanings are entirely different is what I'm trying to say. We have to very clearly understand. For example, you want to earn 15% on the share of TCS. You want to earn 20%, say 30% on Bitcoin. You want to earn 6% for Government of India bond. From different types of investment, you want to earn different rate of return. You require to earn different rate of return. My question to you is why? If you expect to earn 7% from bank FD, will you be also, if you require to earn 7% on bank FD, will you be ready to earn the same amount even on the share of TCS or same amount on Bitcoin? Is my question to you all. Please respond. Please, 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 please. The more you participate, the more you evolve. Otherwise, it will be the same old boring way of learning things. Aksa says no. Atulya, what do you say? Avinash, what do you say? Sivasurya, can you give me a shortening for you? What can I speak to you? Will the Suryan sufficient? Or maybe only Shiva? Surya. ठीक है. Thank you, boss. So, sir, how much I require to earn from an investment depends on the risk which is there in that investment. When I invest in bank FD, the risk is least, I expect a lower return. When I invest in gold, the risk is slightly more, I expect a higher return. When I invest in the share of TCS, the risk is further higher return. And Bitcoin, highest level of risk, maximum level of return. So required rate of return means the minimum rate I want to earn on that opportunity, on that investment. It depends on the risk involved. Risk involved is what it depends on. But sir, what is the use of rate of return? What is the use of this required rate of return? Sir, this is that rate which is used as a discounting rate, people. Whenever it comes to discounting the cash flows, compounding the cash flows, which is that rate of return to use to calculate that PV or FV? Sir, it is the required rate of return which is used to calculate PV of cash flows. Yes, it depends on the risk involved. It has three components actually. This is not something you have to specifically mug up. This is something you have to more primarily understand. We won't dig down very much into it. We will be a bit exam oriented. As I said, sir, real risk-free rate plus inflation premium and risk premium are the three components. When I invest in any security which has no risk, which doesn't have the effect of inflation included in it, which is why I'm calling it real, then such a rate is called as real risk-free rate. Imagine you invest in the Government of India bond, which means there is no risk. And also imagine the Indian economy does not have inflation. The apple which cost rupee 100. 1 second. Are you clear? Are we aligned to the same apple and not this apple? Everyone, you must realize the apple which we are able to afford now is this one and not this one, not the phone. Suppose an apple which cost rupee 100 in India will cost the same after a year, which means there is no inflation in the economy, then my required rate of return is this, a real risk-free rate. However, if the Indian economy has inflation, then I would want inflation premium also. My overall required rate of return will be the real risk-free rate and the inflation premium. Anything without inflation premium is called as real, and with the effect of inflation premium, it is called as nominal. So with these two components, the rate is collectively called as nominal risk-free rate. Sir, why risk-free? Because I'm still making investment in Government of India bond apparently having no risk. Sir, rather than investing in Government India bond, if I invest in the share of TCS, then what I would require to earn will be real risk-free rate. Plus, since Indian economy has inflation, I would want to earn inflation premium. And since there is a risk in that share, I would want to also earn risk premium. And that's my total required rate of return will be. As I said, required rate of return depends on the risk which is there. Higher risk premium, which is why the higher rate of return I would want to earn. And the rate so calculated is used as a discounting rate in any of your practical question topics. Boss, how much out of 10 could you understand this entire thing? Please everyone respond. Come on. Please everyone respond to it. Are we all set? Sir, true or false? True or false? A nominal risk-free rate plus the inflation premium gives me a real risk-free rate. Nominal plus inflation is equal to the real risk-free rate. Is it correct? People, true or false? So nominal is something which already has the effect of inflation included in it. So from the nominal, if you eliminate inflation, we get real. It was false. Sir, now we understand expected rate of return. Required was how much I need to earn based on the risk which is involved. Expected is how much I think I will be able to earn. First was how much you need. Second is how much can the security give. How much can that asset give to you? This was your part, your requirement. This is that assets part. How much can it give to you? For example, I'm expecting due to this tariff. Hello, are you people connected to the real world news around you? Have you heard Trump has imposed certain restrictions on visa, hiking the visa fees significantly? People in the class, have you heard anything of this sort going on? H1B visa fees has been drastically increased by Trump. Yes or no? Yes. So what happens is that a company like TCS, I don't want to enter into practical world, just a one-liner. TCS has 95% of its business outside India with at least a 25 to 30% business in US. It has its Indian employee which are sent to US to work on those projects or whatever. Please tell me, will this step by Trump affect the share of TCS? The price of share of TCS? Yes. TCS has risk. I want to earn this particular return, but the given the action taken by Trump is expected to affect the share price inversely. The share price is expected to go down. I require to earn high, but the return that asset will be able to give to me, the return I think I will be able to generate is low. I want to earn high is a different thing, but I will be able to earn low is a different thing. Are you able to differentiate the two things very clearly? One is what you want, second is how much you think you'll be able to get. Please, everyone. So suppose you stand at 0 point today, where the price of a particular share is 100 and you think after a year the price is expected to be 115. Let me call 115 to be the expected MPS. Today the price is 100. The price after a year is expected to be 115 with the dividend of 0. How much is the expected rate of return? How much you think you will be able to earn? Sir, it is P1 minus P0 plus D divided by P0. The logic remains same. In the denominator comes the amount that got invested. In the numerator comes the amount of return that got generated. By investing 100 rupee, how much will I earn? I earn 115 minus 100, which means 15 rupee of capital gain and 0 rupee of dividend, which means I'm expected to earn 15%. Sir, if the share price is expected to go down to 90, so 90 minus 100 plus 0, 90 minus 100 plus 0, everyone in the class, is negative 10%. So expected rate of return is negative 10, but the required rate of return is still 15. I will require 15 based on the risk involved, but given where the share in what is the position of this share in the market, it is expected to perform by negative 10%. Yes. So we can say that there can be two parts. This entire formula can be broken down into two parts. One is P1 minus P0 divided by P0 is called as capital gain yield, and D divided by P0 is called as dividend yield. Sir, the expected part, expected return, has two components, capital gain yield and the dividend yield. Are you understanding? In fact, let me tell you, wherever in the entire syllabus, wherever you listen to this word called as yield, it always means return. It always means the return which is based on some kind of market price. Do you remember dividend yield, which was dividend as a percentage of MPS? That is what it is, dividend as a percentage of MPS, which is price in the market P0. Capital gain, which is P1 minus P0 as a percentage of MPS of P0. Sir, that's how your expected rate of return is calculated. I need a small validation from every single student sitting. Boss, are we all set? Boliye. Are we all, people in the class, really set? Please speak up. Yes. So great, great, great. Next is the concept of IRR. We don't pay very much attention today to learn this concept. Okay. Then is the concept which is related to interest rate. In this power batch, we will learn what are the different kinds of interest rates, their interpretation, but we won't learn how do you calculate PVFV. Can I expect this much from you people, that you people would know how do you calculate present value, how do you calculate future value? Everyone, this much can I expect? Please speak up. Yes. So this particular part of calculating present value and future value, which is on page number 9 of the soft copy of notes you will receive, right? Please remind me on the Telegram channel. I'll share with you the soft copy of the outnotes. You will have to refer to the same, will also get uploaded in the Google Drive link that you will get. Okay. For outscanner, I'll need 1 or 2 more days, but for the outnotes, I'll update it immediately. Yes. So on page number 9 of the soft copy of the book that you receive, you will have this discussion of present value, future value, which you will have to go through and understand at your own. Only after you have understood it, you will be able to understand the coming chapters. That's why I'm specifically saying must visit, go through it before we meet back in the next lecture. Yes? Fine. Sir, what are the different kinds of cash flow? Again, it relates to something really basic. Sir, we will cover it today, but not now. It is when we learn the chapter of advanced capital budgeting. Alright, then there are some rounding off rules. We will refer it over the time. Day counting rules, we will refer it over the time. Calculating e to the power x, dirty power calculation, all these other things we refer it over the time when we reach to those particular topics. Now, after learning the basics that we have discussed, we are all set to move to the very first chapter we're gonna cover in this power batch, which is chapter of equity and business valuation. Yes. So we are supposed to start with that chapter, but I think we all should proceed to take a break first of all. Sir, it is 10:38 right now. A 15-minute break we take. Today, since things were easy, relatively a smaller back, so please be back by 10:50. People, post which we start with this new chapter. Everyone. 10:50. Will that do? All right. So people, go for a break. See you all after the break. Oh, the screen is not visible, it seems. Screen, oh, all right. I'll figure it out. You all please be back by 10:50. चलिए बॉस, so tell me, are you all back? Come on, life people, are you all please back? बोलिए. So sir, what do we need to start with today? Now I mean to say the chapter of equity and business valuation. I'll make you people re-understand what this chapter is. If I talk about the security valuations chapter by institute, which is as per their study material, that chapter has 4 securities: preference share, bond, money market securities and equity shares, right? The first 3 securities are covered under the chapter of fixed income securities. The last security, which is equity valuation and business valuation, are covered together in this chapter called as equity and business valuation. Yes, we will start with this particular chapter now, equity and business valuation. For that you need to come to page number 17 of your out notes. Page number 17. Come on. In this entire chapter, people, we will, using different models, we will try to find the value of equity share or value of the entire company. What can those different models be? First, with the help of dividend, we will find out the value of share. Then, with the help of cash flows of the company, we will find its value. Yes. Then, with the help of assets of the company, we will do it. Then, using the earnings of the company, then using the relative valuation, and then are the other important topics. Which means most importantly, you all should realize that a company can be valued not just using its dividend, but also maybe using its cash flows or assets or earnings or anything. Using anything, we can value the company. The first category, everyone, is dividend based valuation. The name obviously itself says what? We can value the company. We can value the company using the dividends that a company distributes. And I will explain to you now one fundamental rule, one basic rule which will be of use to almost entire AFM. What is that rule? The fundamental rule is value of an asset today. Today, if you and me value an asset, value of an asset is present value of future cash flows that assets will generate. Yes. You talk about an asset, you want to calculate its value. Whatever future cash flows this particular asset will generate, so the present value of those future cash flow is the value of that asset today. Now let us think about different assets. Sir, today if I talk about equity share, when you invest in the equity share today, what do you get? Sir, we get future dividends. When you talk about preference share, what do you get? We get future preference dividend. When you invest in a bond or a fixed income security today, what do you get? Future coupons and the redemption value of the bond. That's what I'm saying. Whatever future cash flows that particular asset will generate, present value of those future cash flows is the value of asset. So equity share will be present value of dividend and sale price. Bonds will be present value of coupon and redemption value. And for any other asset, present value of cash flows. Now, sir, the value that we calculate is called as intrinsic value, is called as fair value, is called as equilibrium price. But why do we calculate these values? The share already has a price in the market called as market price per share, called as MPS. What is the point of we calculating value? What is this value? So you have to please understand, the value which is there in the market is the actual market price. and the value that we calculate is the intrinsic value, which tells you what should be the price. One is what is the price in the market, another is what should be the price, its true worth, its true value based on its cash flows. For example, you suppose calculate the intrinsic value. How do you calculate? We will learn. How do you calculate? We will learn. But the value that you calculate shows the true value of that share. For example, the intrinsic value you calculated is 1000. The price of the share in the market is 1200. Now you all apply common sense. That, sir, according to my calculation, the true worth of an asset is 1000, of a share is 1000, and the price of that share in the market is 1200. Is that share worth buying? Will you invest, everyone in the class, in that particular share? Will you ever invest in that particular share whose market price is 1200, but in your understanding its true value is just rupee 1000? Everyone please respond. No. Such a share whose price is whose price in the market is more than intrinsic value, we call that share to be overvalued share, and we have to sell that share. Which means, using the intrinsic value which you arrive using the concepts of valuation and comparing it with CMP, you can always, everyone in the class, take your investment decision. Do you remember early morning I was trying to explain to you the equity research where I talked about valuation, where I talked about coming to a recommendation or advice whether the share is worth buying or not? That is what exactly you are doing here. Sir, you calculate the intrinsic value of a company's share being 1000 and its price in the market is 800. Now you apply your brain. There's a share in the market trading at 800, but I know at the back of my mind, as per my calculation, that its true worth, its intrinsic value is 1000. Is this share worth buying? Obviously, sir, this share is an undervalued share. Its price in the market, its actual price in the market is less than its true value, sir, which is why it is undervalued. We should buy that share. And if the MPS is equal to intrinsic value, we call the share to be fairly valued and the action is hold. Yes? There are a lot more things. I mean, there are small further addition to your knowledge that we can make. But from exam point of view, there is no need, which is why we don't discuss them. But if you talk about the regular batch perspective, there is a lot more that we can discuss here. But yeah, for simplicity, you have to understand one thing very clearly. For correct conclusion in the exam, you have to understand one thing very clearly. Suppose share price, the intrinsic value that we calculate is 1000, which is more than the market price which is there. I'll repeat my lines, please pardon me. The price, the intrinsic value that I calculated is 1000. This is more than the price of 800 in the market. Can I say the share is an overvalued share? Come on. I need a response from every live and recorded people in the class. Please respond. Can I say the share is an overvalued share? What do you all think? Everyone. Super, ultra, fast. Please respond. What do you all think? Come on. No. Because, sir, what we have to comment on is the actual price and not the intrinsic value. You will have to always comment on the actual price and not the intrinsic value. On this price, you comment if this is more than intrinsic value, then the share is overvalued. And if this price is less than the intrinsic value, then it is undervalued. All right. This is a simple thing. Sir, now is the next question. Sir, we understand that we calculate intrinsic value. What is the use? Sir, this is the use. How do we calculate the intrinsic value? Present value of future cash flows. Now we have to understand two aspects. When it comes to the present value, there are two broad ways we can do it, two broad category. And when it comes to present value calculation, we also need a discounting rate for it. First, the two broad categories of calculating present value. Sir, possibility one, when examiner specifies some particular number of years for which we will hold the share. For example, examiners say that what will be the value of share today which you are planning to hold for the next 5 years. In such a case, I have my holding period being a definite number of 5 years. I will be given the dividend of next 5 years. I will also be given the selling price at the end of 5th year because my holding period is definite number of 5 years. Unlike this is a situation where examiner does not specify for how many years are we going to hold that share. A share as per such question is assumed to be held for infinite number of years, which means from today till forever I will keep on receiving only dividends and dividends and dividends. No sale price would be received. Are you people clear with these two broad categories? 90% question belong to this category, only 10% question belong to this particular category. But the logic of every possible category is same, that present value of future cash flows. When you hold a bond till particular number of years, can I say the future cash flows will be those number of dividends? Dividend from first year to 5th year. Also sale price at the end of 5th year. These are all future cash flows. I need to calculate the present value. I need to discount those future cash flows at the rate of KE, at the rate of my discounting rate, which is cost of equity, which is the required rate of return in case of equity investment. People, before I proceed further, before I explain it ahead, are you people aligned to what I have explained out here? Are you people aligned with what intrinsic value, fair value, equilibrium price is? How is it the present value? What is its use? And how do you specifically calculate PV in case of life being till some definite number of years? Please tell me. Come on, come on, come on. Respond. Settled are we all? Any doubts you may please ask. If no doubt, you all please respond. Then we proceed. So I will now take you to the next discussion. That, sir, suppose examiner says there is a share which you are going to hold for infinite number of years. What is the present value of that? What is the intrinsic value of that share? We say as per fundamental rule, the value of a share is the present value of future cash flows. The point is, in this case, the future cash flow is from D1 till D infinity. I will have to discount the dividends till infinite number of dividends. I will have to discount. At what rate? At the rate of K, I will discount them. At the rate of K, I will discount them. Yes. Sir, how do I discount a dividend which is still infinity? That we will learn, that we will figure out. But at least in your brains, you should realize, sir, out here I have dividends and sale price to be discounted till a particular point, and here I have to discount it till infinity. Yes. Sir, question is, how do we do it? For that, we will have to make use of maths, which is where some formulas will come into picture. We will talk about it, but for now, very importantly, sir, whether it is this case or it is this case, we should have a discounting rate which is KE. Extremely basic. there are three ways in which you can calculate KE. In fact, three sequential ways. Your first priority, your first preference, you don't have a choice. First, you try this. If this doesn't work, then you try this. If this doesn't work, then you try this. This is the sequence in which you will always calculate K in the exam hall. First, using CAPM, which is nothing but RF plus beta into RM minus RF. A great basic, no logics to be discussed. Detail will be covered in the portfolio management, first thing. And second thing, sir, RM means market's rate of return. Stock market's rate of return. RF is risk-free rate of return and beta is beta of the security. Correct? Sir, how would examiner give me the market rate of return? It may directly say the rate of return of market is this, or it may say the index has given me a return of this much, the index is expected to give the return of this much, meaning to say index may also be like it may be used as an alternative word of market. Second, RF, the risk-free rate of return. The examiner might directly specify to you that the risk-free rate of return is this, or examiner may possibly tell you that Government of India bond yield, the return on Government of India bond is yield is this, the return on treasury bills is this. Sir, a government security is considered risk-free, whether it is Government of India bond or the treasury bill, sir, is considered the risk-free rate. The beta, everyone, is the risk, the systematic risk, the details of which will be covered in portfolio management. So RF plus beta into RM minus RF is CAPM, where RM minus RF, this much part is specifically called as market risk premium, and beta into RM minus RF is specifically called as security risk premium. These terminologies has to be equally clear to every student, not just the formulas. The inputs, etc. things are very important. Yes, sir, then what do we talk? Sir, if this way you are not able to calculate KE, then second option is Gordon's formula, which is nothing but D1 divided by P0 plus G. Sir, this is again something you all have really done at CA interlevel. It is a modification of official Gordon's formula, sir. D1 divided by K minus G is equal to P. Using this formula, if I have to calculate KE, this is how it looks like. Sir, what if this data is also not given in the question? Then last is earnings yield. Do you remember dividend yield? What was it? Dividend yield, everyone in the class, what was it? Please tell me. Come on. Come on, come on. What was dividend yield, by the way? Speak up. Sir, dividend as a percentage of MPS. I said whenever there is this word yield, we take it as a percentage of MPS. So, dividend as a percentage of MPS was dividend yield, and earnings as a percentage of MPS is earnings yield, which is EPS divided by MPS. EPS divided by MPS. So, now you have to learn what? You have to, sir, do, sir, third way of calculating earnings cost of equity is this. Sir, it looks similar to some other formula which we have already done. Sir, it looks like the formula of P ratio. P ratio actually is EPS, MPS divided by EPS. This is P ratio. P ratio is MPS divided by EPS, whereas earnings yield is EPS divided by MPS. So can I say, sir, using the last formula, we can say K is nothing but 1 divided by P ratio, the inverse of P ratio. These are the ways we can calculate KE, not just in this particular topic, but in the entire curriculum. First. Second, sir, you explained that discounting rate is the required rate of return, correct? How much I require to earn. So in case of equity, the required rate of return is called as cost of equity. Yes. And sir, expected rate of return is different. Yes. However, there is this specific situation where expected rate of return and the required rate of return both are same. How much I expect is the same I require, or how much I require is the same that I think I will get, I will expect. Correct? Sir, this is in case of a fairly valued security. I will explain to you a rule now, but the logic I will not explain. Logic will get covered when we go to portfolio management. This is specifically mentioned out here. Page number 121, something that you learn in portfolio management. You will very clearly understand what I mean. Anyways, what I was trying to tell you, whenever a security is fairly valued, which means its price in the market is same as how much it should be, its MPS is equal to intrinsic value. Sir, whenever a security is fairly valued, in this particular situation, everyone, whenever a security is fairly valued, in this particular situation, we can say the expected rate of return. The expected rate of return is considered same as required rate of return. Sir, what is the logic? How can I say that when the share is fairly valued, I will get the same as I require? The logic you will learn in portfolio management, but the point I wanted to convey to you is that when you go to the practical questions, you will see that examiner give you expected rate of return, not required. And same expected rate of return is used as a discounting rate. How the hell is this possible? Sir, that is completely illogical. But only if you assume the security to be fairly valued, it become logical, because in that case expected become required. People, this particular thing could I explain? Please respond. Most of the students are not clear with the fact that I cannot logically use expected rate of return as discounting rate. However, with the assumption that the security is fairly valued, it can be used interchangeably, which means examiner assumes the security to be fair valued, which is why it is giving me expected rate of return and not required. The answer is yes. Please, everyone in the class, tell me, could you understand this particular part I was trying to explain? Boolean. You need to respond to me with two things. How is required rate of return, which is KE, calculated? And second, how can required and expected to be interchangeably used? Boss, please respond. Please respond. Waiting. Only after every single student in this class will validate, I will proceed. Any doubt, don't even hesitate. Slightest, silliest doubt, no point of hesitating. We proceed. So let us come to the dividend discount models. One second. I had written one minute, people. Huh? Just a minute. All right. Yes, people. We all proceed. Shall we go ahead? Fine. So, sir, kindly start to think with me so that you don't have to mug up even a single formula. Sir, ultimately we have to do present value of future cash flows. In case of definite number of years, future cash flows, these are the future cash flows. Right? Discounting these future cash flows is really easy. Right? That is just 10% part of this topic. 90% part of this topic is discounting the infinite number of cash flows. How do you do that infinite number of cash flows discounting is using the dividend discount models, and the first dividend discount model we have to look at is zero growth model or constant dividend model. Sir, next model is constant growth model, Gordon's model. Further next model is variable growth model. Sir, do we have a choice that we can apply any model that we want? The answer is very clear, no. Depending upon what kind of data is given, it automatically gets decided which model will apply. I'll give you an example. First model, zero growth model. It gets applied when you have same amount of dividend every year till infinity. Which means imagine that the dividend of first year is rupee 10. Then if we assume that same 10 rupee of dividend will be received till infinity, then you apply this model. As the name itself says, there is zero growth in your dividend. The amount of dividend is constant. Next model gets applied, constant growth model, when there is a growth in the dividend which is constant every year till infinity. Let's assume that first year dividend is rupee 10. And this 10 rupee dividend is expected to grow by 5%, let's say, till infinity. Which means first year dividend is 10, second year it will be 10.5, then further 5%, then further 5%, so on till infinity. If that is the case, it gets covered under constant growth model. Similarly, what is variable growth model? We will learn later. So you have to first of all identify the type of growth which is incorporated in the dividends, and accordingly a model is chosen. Yes, for example, people, if you receive the same amount of dividend forever till infinity, it is like an annuity. It is like an annuity. And how do you calculate the present value of annuity? How do you calculate the present value of perpetuity? The perpetual annuity, the annuity till infinity is called as perpetuity. And what is the present value of perpetuity? Sir, A by R. A was the amount of annuity per year, R was the discounting rate. In our case, the amount of annuity is dividend and the discounting rate is KE. And this way, if you do D1 divided by K, if you do, what are you doing? You are doing the present value of all future dividends till infinity. Starting from D1 till D infinity, if the amount of dividend is same every year, so D1 divided by this K will give me the present value, the price of the share, the intrinsic value at 0 point. The main point of learning is not this formula, but analyzing the inputs we have used in this formula. Sir, when I talk about dividend, I should consider the dividend of first year as my first dividend. It is not the dividend of 0 year, it is the dividend of first year. Second, if I use the dividend of first year and I discount it, I bring it to 0 point, which means the value that is arrived is called as intrinsic value or P0. Are you all, please everyone in the class, understanding it? Similarly, in case of constant growth model, the formula is really simple, but applicability should be more clear that, sir, I have my first dividend at the end of first year. These dividends will grow at a constant rate till infinity. Growth of what? Growth of dividend matters. Growth of dividend matters. G is your growth of dividend, right? So D1 divided by K minus G, which is the Gordon's formula, give you the value of share at 0 point. What is this formula doing? You don't have to remember only the formula, but also realize what is this formula doing. This formula, everyone in the class, is doing the present value of future dividend, future constantly growing dividends till infinity. All these dividends are discounted in this value calculated as D1 divided by K minus G. Everyone, are you all aligned with these two formulas that we have discussed? Please speak up. Are you all aligned with these two very simple formulas? But do you know the point to be understood? People, the point to be understood is not just these formulas. That you all would already know. The main point is to understand the minuteness, the detailings of this formula. Sir, in this formula, I take D1 in the numerator. What if the D1 is not available? Only if D1 is not available, I can use it D0 into 1 plus G divided by K minus G. First thing. Second thing, in the formula, the first number is D1, which means if I imagine the future cash flows, sir, it is D1, it is D2 and so on till D infinity. My question to you all is, if I calculate the present value at 0 point, which is the first dividend which is getting discounted, is it D0 or is it D1? Which is the first dividend which is getting discounted through this formula of D1 divided by K minus G? Come on. Is my question clear to every single student sitting here? What is my question? My question is really simple that sir, if I calculate through this formula the value of share, it is doing the present value of future cash flow. Which is my first future cash flow? Is it D0 or D1? Is my question. Recorded people, if you think you evolve, if you don't, obviously this batch is not there just to mug up the questions. Sir, the first dividend which is getting discounted is D1 and not D0. This is second level of minuteness. Because the logic says that the value of share is the present value of future cash flows. My first future cash flow is going to be D1, so D1 is important. D0 is not considered in this formula anywhere, as you have to realize. Second, sir, D1 is fine. K is the discounting rate, that is also fine. But did you observe? If you use D1, the value arrived is obviously at a 0 point. If I use D1, the value so arrived is at 0 point. Third, when you talk about growth, G is officially called as sustainable growth rate, SGR. What is G called as? Sustainable growth rate. So we have to consider the sustainable growth rate of what? Of earnings of the company, of revenue of the company, or the dividends of the company, because what we discount is the dividend. So SGR is nothing but sustainable growth rate of the dividend. From which year to which year? From 0 to infinity? No. Please, you have to carefully understand this, that sir, on the timeline, my first dividend is which is discounted is D1. This formula has nothing to do with what happens from D0 to D1. But yes, from D1 till D infinity, from D1 till D infinity, people in the class, the growth rate of dividend should be constant. It cannot be changing, like in a year it is 10%, another year 8%. No, then you cannot apply the formula. Sir, by growth rate, by G, I mean growth rate of dividend from year 1 to year infinity. Everyone in the class, please respond. Are you people clear with this? Speak up. Come on, come on, come on. So we have learnt we use D1 in the formula. We have learnt we get P0 in the formula. Sir, growth that we talk about is from D1 till D infinity, not D0 to D1. And last and most important, I'll speak up, but first I'm waiting for your validation. If you are missing anywhere, I can repeat it twice. But without your validation, I will not go ahead. So please respond. What is the status? Come on, come on, come on. People waiting. Give me a minute, let me have water. Everyone, waiting for people, your responses. Are you settled with the discussion we have made? Come on. You all respond, then we proceed ahead. Please tell me. Are you there? Understanding everything? Come on, live people, recorded people, speak up. Guys, I am not able to see your responses. Yes. These implications, please listen to me. These small things, what you are learning, are not for theory. As we move to practical question, I'll make sure that you are making use of such things. That what matters to you is the growth of dividend. Because examiner in the practical question is going to give you the growth of earnings. Without this knowledge, out of ignorance, you will assume the same rate of growth of earnings to be the rate of growth of dividends. But that may not be always true. The examiner, if I don't mention, if I don't specify that the first dividend being discounted is D1 and not D0, you again might make a mistake of assuming that okay, even D0 is discounted in calculating P0. You all might think that even D0 has been discounted, which is not the case. That's again a possibility of mistake. Sir, next two important things. If the examiners say the company is expected to distribute dividend, the company will declare a dividend, will pay dividend, I understand it is D1. If examiner says company just paid a dividend, company declared a dividend, I understand it is D0. What if the examiner says company pays the dividend? Or examiner say following is the given information, DPS this, EPS this. How do I figure out if this dividend is D0 or D1? Sir, that is where the ambiguity comes into picture. Sir, I observed all such question where institute, was not clear, had this ambiguity. And I analyzed to understand that in such situations, in most of the cases, except for 1 or 2, 3 questions, in rest all question institute assumed the given dividend to be D1. Are you all understanding? If the language of the question is unclear about timing of dividend, then assume it as a D1. If the language is clear, obviously there is no need of assumption. So in the outnotes that you are referring everyone in the class, all such important notes, all such important conclusions have also been integrated. Yes? Sir, next important thing. Is the growth of earning and the growth of dividend same? People? Is the growth of earning and dividend same? Will the earnings and dividend grow at the same rate? The answer is clear, big, no, not always. But then, when would it grow at the same rate? Sir, first thing is clear, what matters to me is the growth of dividend. But will this growth rate be different from the growth of earnings? Let me explain to you. Sir, imagine that at 0 year company earned. In this entire year, if I talk about in the entire previous year, if I talk about company earned an EPS of rupees 100. Which means at 0 point when I stand, I see an EPS of rupees 100 where my payout ratio is 50%, so my DPS is 50. Aligned, easy, practical. Suppose the EPS of the company grows by 10%, earnings of the company grows by 10%, and assume that the payout ratio for first year end is also 50%, which means earnings of rupee 110 after 10% growth rate, from which if 50% is distributed, dividend is 55, and if I calculate the growth rate of DPS, it also turns out to be 10%. From 50 to 55, 10%. Agreeing? Are you all please on it? People. Basic. What conclusion can we draw? We draw a conclusion that if the payout ratio is same between the 2 points, if we have to figure out the growth rate of earnings and dividends, what we say? If the payout ratio for both the points is same, then growth of earning between that point will be same as the growth of dividend for that point, between those 2 points. I can say otherwise as well. The growth of dividend between those 2 points will be same as the growth of earnings if the payout ratio is same. Now, I conclude it again. Suppose at the end of first year, if my EPS is 110, suppose with further 10% growth rate, I see that the EPS has become 121. But this time, at the end of first year where my payout was 50%, now suppose the payout gets changed to 60%. Can you all please on your calculators calculate the amount of dividend? Sir, 100 into 50% is 55 rupee of dividend. 121 into 60% is what amount of dividend? 121 into 60% is 72.6 rupee of dividend. My question to you all is, growth in the earnings has been 10%, but growth in the dividends is how much? Is it 10% only? Or some other rate? Everyone, please do calculate and give me this response in the chat box. Is it same or different? Give me this response in the chat box. Everyone. Then after this, I tell you the most important part of this entire learning. That's sir, why are we learning this? Come on. Sir, if I calculate, it is 72.6 minus 55 divided by 55, give me 32% people, give me 32% of dividend growth rate, which means can I conclude? Which means can I conclude the growth of earnings is 10% but the growth of dividend is 32%. It is not same as earnings. Why? Why? Because sir, the payout ratio between these 2 points, the payout ratio has changed from 50 to 60%, which is why the growth rate of earnings between these 2 points is not turning out to be the growth rate of dividends between these 2 points. Now the main applicability. The objective in our class is not to just understand something but also talk about its applicability. You are looking at a question and the question says that earnings are growing at the rate of 10%. Now what? What do you need in your formula? Growth of earnings or growth of dividend? Sir, dividend. Then examiner is silent about the growth of dividend. If you assume it to be the same, it is your ignorance, it is not your logic. We have to crack it. We have to literally crack it with our logic that, sir, is the payout ratio changing? No, which means now I can assume the earnings growth to be the same as dividend growth. However, if the payout is changing, see this, if the payout is changing, then I cannot assume the growth of earnings to be the growth of dividends. Examiner mention earnings. Rest of the brain we will have to apply and figure out what is the growth of dividend, because what formula will make use of is the growth of dividend. Boss. Could I please explain to you? Could I please explain to you the technicalities involved in this simplest formula that you have been seeing right from CA Intermediate? Come on, please explain. Please respond. Waiting for your responses, people. So I would, all those recorded people who are watching this lecture today or tomorrow, I mean, either in your first lecture or max in your second lecture, you need to send to me a WhatsApp with your name, with the point that you are registered for this batch, so that at least I get to know that who all am I connected to for this batch. You need to respond to me with your name, with your attempt you're planning, with your city, the fact that you have registered for this particular batch, and most importantly, are you people learning the things? Are you people liking it or not? Whatever are your genuine feedbacks. Even negative is appreciated, even positive ones is there for my motivation. But you all need to respond. Send that message to me so that we can be connected. Yes? So that is great, people. For today, we will stop the lecture here. Sir, why? Just a 2.5-hour lecture. Reason being, the message that this message of live lecture could reach to some limited people, right? And it being the first day, let us take time to process the things. Next lecture onwards, we will be all in flow. With the lectures now, we will increase the speed a bit so that we don't have to unnecessarily stretch the batch. Yes? So in the lecture today, we are all done till this point. Next lecture onwards, we will start to solve even the practical questions. Obviously, after learning a very small thing, we will go to the practical question, and that is when you learn how important was to understand these small things that you have learned. For this topic, it's not about the formula. It's there in CA Inter also. For this topic, it's about learning these things. Perfect. So great, everyone. If you have any doubt, we all wait. If no doubt, we call it a day. We meet back again in the next lecture day after tomorrow. Tomorrow, as we see, as I said, is puja. I won't be able to be available. Day after tomorrow, I am available, and as you all said, you all will be available. Let's keep a lecture day after tomorrow. Yes, everyone? So that's all. Thank you so much, all the live people, for watching up this lecture. I would really request, if you people liked it, do like it on YouTube. Do share your very genuine feedbacks in the comment section, whether positive or negative. In the comment section, whenever you are watching this video, do share your comments. Alright? Because whenever there is a new watcher, your comments will help him understand whether the lecture is really good or the lecture is really bad. In both the cases, it should be all fair. Yes? Thank you so much, people, for watching up this video. I'll see you again in the next video. In the meantime, you will get rest of the updates regarding books and everything. Alright? So bye-bye, all the live people. Thank you so much for joining in. Let's meet back day after tomorrow, same time, 9 AM. See you all. Take care. Bye, Aksa. Bye, Avinash. Bye, Atulya. Bye, Surya. Bye. Who else is here? All other live people. Atulya. Bye-bye. See you all. Bye, everyone.